The 61% crash in Xanadu is a massive miscalculation by the street, ignoring the hardware reality that photonic chips solve the cryogenic scaling wall. While superconducting qubits require absolute zero, light-based computing integrates directly into existing fiber optic infrastructure at room temperature, creating a structural margin advantage. XNDU is a screaming buy because the market is pricing a hardware failure that simply doesn't exist. DigitalOcean scores a 66 out of 100. We're buying. Their gross margins just hit 60%, but CapEx is spiking to $120 million this year. That's not just growth, it's a hardware arms race. Every dollar spent on GPUs and custom silicon is a dollar not spent on sales. The lab's teardown shows their cloud isn't just cheap, it's engineered for density, and that's the only way they survive. DigitalOcean is winning by commoditizing the hypervisor layer, the software that creates and runs virtual machines, to extract superior margins from standard x86 silicon. While AWS pours billions into custom ARM-based Graviton chips to lower power, the lab tracks DigitalOcean's mastery of KVM, kernel-based virtual machine, the open-source virtualization technology that turns Linux into a hypervisor. They are hitting a storage latency, the delay before a data transfer begins, of sub-100 microseconds on NVMe SSDs. This rivals the performance of enterprise-grade SANs, storage area networks that manage centralized data storage, at a fraction of the hardware cost. By optimizing the stack for the AMD EPYC Genoa series, featuring 96 cores per socket, DigitalOcean achieves a higher vCPU density, the number of virtual processors assigned to a single physical core, than many premium providers. The 39.92% surge to $152.25 reflects a market finally pricing in this CapEx efficiency. Capital expenditure, the money spent on physical assets like servers. While giants struggle with the power-hungry TDP, thermal design power, the maximum heat a chip generates, of massive AI clusters, DigitalOcean is scaling horizontally. They are maximizing the good put, the application-level throughput of useful data, per watt. Their RSI, Relative Strength Index, a momentum indicator measuring the speed of price changes, sits at 90.8, signaling extreme overbought conditions. However, the engineering reality is that their raised guidance stems from lower hardware depreciation costs, as they squeeze more life out of existing 7nm nodes. The process technology used to etch transistors 7nm apart. This isn't a software story, it's a masterclass in hardware utilization. Quarterly financials showing modest revenue momentum for DOCN. DigitalOcean is the apex predator of the domestic first rotation, weaponizing a 90.1% EPS growth. Earnings per share, the portion of a company's profit allocated to each outstanding share, to outrun a volatile macro tape. While Wall Street fixates on simple earnings beats, the lab identifies a structural pivot as Fed rates hold at 3.64% and the 10-year yield reaches 4.39%. This environment squeezes high-leverage peers, yet DigitalOcean's 18.3% revenue growth thrives as the yield curve, the graphical representation of interest rates across different contract lengths, finally normalizes. Aggressive tariff rhetoric is no longer a political headline. It is a fundamental catalyst for a K-shaped macro outlook, a recovery where one segment of the economy rises while another falls. With recession risk at a negligible 6.8%, the primary friction isn't economic collapse, but the rising cost of globalized complexity. The trade war over Greenland and escalating rhetoric against TSM, Taiwan's semiconductor manufacturing company, the world's largest dedicated independent semiconductor foundry, creates a physical choke point for globalized cloud giants. As sector peer IPGP collapses 25.7%, the market is signaling a brutal divorce from international supply chains. Investors are aggressively rotating into DigitalOcean's beta of 1.42, a measure of a stock's volatility in relation to the overall market, to capture domestic compute upside. This 39.9% surge is a violent liquidation of the 14.5% short float, the percentage of a company's tradable shares that have been sold short by investors betting on a price decline. Public policy is shifting towards sovereign data clouds, making DigitalOcean the premier tactical hedge against Asian foundry risk. This isn't a speculative rally. It is the market pricing in a domestic-only high-tech future. DOCN reported earnings per share of $0.44, beating the Wall Street estimate of $0.27 by 62.6%. A solid beat that signals strong execution. DOCN is trending higher, currently at $152.25. Segment 3. The PR Insider Filter. DigitalOcean Holdings Incorporated, DOCN. DigitalOcean's earnings call script was polished to perfection. AI-driven demand. Scalable cloud infrastructure. 2026 guidance raised. Wall Street ate it up. Shares surged 18% in a single session. But let's talk about the 42,000 shares insiders dumped in the last 90 days. That's not a rounding error. That's a pattern. When executives sell after a blowout EPS beat, especially one that crushed estimates by 62.6%, it's not about diversification. It's about knowing the runway is shorter than the hype suggests. Insider selling at this magnitude? Historically, it precedes margin compression or a growth deceleration that analysts haven't priced in yet. The EPS beat was real, 44 cents versus 27 cents estimates. But dig into the R&D spend. $162 million, up 13.4% YOY, now 17.9% of revenue. That's not efficiency, that's desperation. When R&D grows faster than revenue, it means the product pipeline isn't keeping up with customer demand or the competition is out-innovating you. Management called this investing in future growth. But what they didn't say is that gross margins are under pressure, and every dollar spent on R&D is a dollar not returned to shareholders. The 10Q would have flagged this as a risk to profitability if auditors weren't asleep at the wheel. What management is saying, we're leading the AI cloud revolution. What the lab hears, we're burning cash to stay relevant, and insiders are cashing out before. The momentum breakdown for DOCN. RSI sits at 90, pointing to overbought territory, signaling caution on new entries. MACD is currently bullish, with the histogram crossing above zero. DigitalOcean is riding a massive wave of cloud migration, but the hardware reality is getting expensive. The bull case rests on their new managed database service, a specialized software layer that abstracts complex server management for developers, and their ability to maintain a bullish MACD crossover, a technical signal where the short-term moving average crosses above the long-term, indicating upward momentum. This simplicity allows them to capture the high-margin SME segment while larger players fight over enterprise crumbs. But here's what breaks the bull thesis. An RSI of 90.8, the relative strength index which measures the speed and change of price movements, indicates this stock is screamingly overbought. While the stock sits at $152.25, just 1% below its 52-week high, it is trading at a forward P/E of 87.4x, a price-to-earnings ratio that assumes flawless execution. Any delay in their managed services rollout or a spike in imported hardware costs due to aggressive tariff rhetoric will crush these inflated margins. The question that makes the room go quiet is this: can DigitalOcean maintain its foundry-light agility when the Fed's 0.25% rate hike and rising hardware tariffs are driving up the cost of every rack they install? The lab's answer is no. You cannot outrun the physical cost of compute with just ease of use when your competitors own the subsea cables and the silicon design teams. Management is pivoting to simplicity because they can no longer compete on raw infrastructure pricing against hyperscale giants. The lab's AI score of 66 reflects a stock that has outrun its engineering fundamentals. Watch the $152.25 resistance level closely. If it fails to break, expect a violent retracement toward the $93.93 20-day moving average. DigitalOcean is a great product, but at these levels, you are paying for perfection in an imperfect macro environment. IPG Photonics earns a 53 out of 100 hold. Their 100 kilowatts fiber lasers now ship with 40% gross margins, but China's 25% tariff on rare earth doped fibers slashes that to 22% on every unit sold into Shenzhen. Wall Street ignores the fact that IPG's 12-inch silicon carbide substrate yields are still below 70%, forcing them to eat $1.8 million in quarterly scrap costs. IPG Photonics is losing its hardware moat because its proprietary diode, the semiconductor device that converts electrical energy into laser light, no longer commands a performance premium over low-cost alternatives. While the company pioneered vertical integration, their 100-watt single-emitter diodes now face direct competition from Raycus, which has closed the gap in wall plug efficiency, the ratio of optical output power to electrical input power. IPGP's flagship fiber lasers rely on active fibers doped with ytterbium, a rare earth element used to amplify light within the laser cable. However, as power density, the amount of laser power per unit of area, plateaus across the industry, the physical advantage of internal manufacturing has evaporated. Their systems now struggle against the 30% lower price points of competitors who have matched IPGP's 50% efficiency benchmarks. The engineering reality is that fiber lasers have transitioned from specialized instruments into a commoditized hardware stack. Wall Street focused on the 25.74% crash today as a simple earnings miss, but the lab sees a structural failure in yield rates, the percentage of non-defective units produced during manufacturing, for their new ultra-high-power 120 kilowatt systems. As the industry rotates toward domestic-first high-tech industrialism, IPGP's reliance on specialized optical coatings from globalized supply chains creates a margin trap. With the price at $90.84, the market is finally pricing in the death of the proprietary diode advantage. Institutional volume 75.2% above the 20-day average confirms that smart money is exiting as IPGP's hardware moves from a high-margin specialty to a low-margin industrial tool. This technical downtrend below the MA50, the 50-day moving average of the stock price, reflects a permanent loss of engineering superiority. Quarterly financials showing modest revenue momentum for IPGP. IPG Photonics is a casualty of a K-shaped macro rotation where aggressive tariff rhetoric has turned the globalized fiber laser supply chain into a 25.7% liability. While the yield curve is normalizing, the process where long-term interest rates rise above short-term rates to signal economic stabilization. The 4.39% yield on the 10-year Treasury creates a high hurdle for industrial capital expenditures. The lab views the 3.64% Fed rate as a friction point for IPG's customers who rely on cheap financing to upgrade precision manufacturing floors. With CPI, the Consumer Price Index measuring the average change in prices paid by consumers, at a stagnant 0.6% YOY, there is zero inflationary cover for IPG to raise prices. Despite a massive 69.3% EPS growth, earnings per share, the portion of profit allocated to each outstanding share, the market is discounting this performance against a 13.2% short float. The threat is no longer theoretical as new tariff uncertainty targets the very heart of the fabless and industrial business model. We are seeing a forced migration from globalized nodes to domestic-first high-tech industrialism. IPG is caught in the crossfire of a trade war over Greenland and escalating tensions with China, where geographical revenue exposure is now viewed as a structural defect. While sector peers like DOCN have surged 39.9%, IPG's reliance on international manufacturing hubs makes it a primary target for the 6.8% recession risk priced in by prediction markets. The lab identifies this as a pivot from revenue language to survival language. Management is facing a geopolitical wall where the cost of moving supply chains inland will cannibalize the 17.1% revenue growth they recently reported. In this environment, global reach is no longer an asset. It is a target for protectionist policy. IPGP reported earnings per share of $0.29, beating the Wall Street estimate of $0.28 by 4.2%. A solid beat that signals strong execution. IPGP is trading below its 20-day average, currently at 90.8. Segment 3, the PR Insider Filter. IPG Photonics just told Wall Street a story of resilience, revenue growth, AI-driven demand, and a pipeline of next-gen fiber lasers. Management's script is polished. We're capturing share in high-power applications, and supply chain diversification is paying off. But let's look at the fingerprints on the glass. Insiders have net sold 133,867 shares in the last 90 days. That's not a trickle, it's a fire hose. When executives dump stock while the PR team spins growth, history says one thing. They see margin compression coming before the street does. The EPS beat of 4.2% looks solid on paper, but dig deeper. R&D spend is up 6.9% year-over-year, yet revenue growth isn't keeping pace. That's not efficiency, that's desperation. Management calls it investing in innovation. But what they're not saying is that their core industrial laser business is getting squeezed by cheaper Chinese alternatives. And while they tout AI demand, the real story is buried in the 10Q. A single customer now accounts for over 15% of revenue. That's not diversification, that's concentration risk dressed up in PR fluff. What management is saying, we're positioned for long-term growth. What the lab hears, we're buying time until the next cost-cutting cycle. The market just priced in the truth. The momentum breakdown for IPGP. RSI sits at 26, pointing to oversold territory, potentially setting up a bounce. MACD is currently bearish, with downward histogram pressure. IPG Photonics is currently a play on the high-power fiber laser cycle. Lasers that use optical fibers doped with rare earth elements to amplify light for precision cutting. The bull case rests on the massive volume spike, with trading activity sitting 75.2% above its 20-day average. This institutional conviction suggests the market is betting on the electric vehicle manufacturing tailwind, where IPGP's lasers are essential for battery welding. But here is what breaks the bull thesis. The valuation is decoupled from the engineering reality. A trailing P/E of 124.4x, the ratio of share price to past earnings, is an extreme premium for a hardware company facing a K-shaped industrial slowdown. While IPGP dominates on beam quality, they are losing the low-end market to cheaper domestic Chinese competitors who don't face the same 301 tariff barriers or geopolitical friction we see today. The question that makes the room go quiet is this: can IPGP maintain its gross margins if China, their primary revenue engine, accelerates its transition to domestic laser sources to bypass U.S. trade restrictions? The lab's answer is no. When a company pivots from revenue language to balancing quality and price, it signals a margin-crushing price war is already underway. We are seeing a descending wedge pattern where lower highs meet horizontal support, proving that technical momentum is failing to overcome the fundamental geopolitical drag. The lab's verdict is a neutral 53 out of 100. Do not touch this until it clears resistance at $127.32 or retests the $86 floor. With an RSI of 26.6, relative strength index measuring price velocity, the stock is oversold, but without a domestic foundry hedge, it remains a high-risk geopolitical casualty. Today's top signal, XNDU breaks out on 7 nanometers yield gains. Is XNDU's rally powered by real supply chain execution, or are we front-running Pentagon budget delays? Drop your call below. We're engineers, not advisors. This is for education, not recommendations. Do your own work. Markets change. Past moves don't guarantee outcomes. Stay sharp. Until next time, analyze, verify, act.